Well, greetings and salutation, SIE exam test takers. This is Dean Tenney, aka also known as the Series 7 Guru, coming to you with episode 10, I believe this is, of our SIE exam podcast series. We have one more episode after this. Today's episode is going to be Knowledge of Capital Markets, which is 12 questions on your SIE exam. For the most part, we've been following the FINRA test content outline for the SIE, and we've been doing it in reverse order of how many questions, right? So we're going from most testable sections to least testable sections, and now we're in the section one, which is kind of interesting, right? Section one, but it's the third in terms of testable content. Anyways, economics and offerings. Nobody expects you to be an economist. We do expect that you don't embarrass the firm at a cocktail party. I always joke, if somebody asks you about economics, finance, or investments, and you want to sound smart, you should say it has a lot to do with interest rates. And if you just shut up, you sound pretty good. They say, well, what about them? You say they fluctuate. They say, is that good news or bad news? You say, it depends. Can you tell me more? You want to spice it up. You can say you're watching the Fed, the longer you go without answering the question, the smarter you'll sound. I'm joking, but right. So we're talking here about 1.3 economic factors as it relates to the actual exam, the SIE exam. And one thing you're certainly tested on in terms of economic factors is fiscal policy. Fiscal policy test question is government spending and taxation. There's monetary policy, the money supply, and then there's fiscal policy. You need to be able to distinguish between the two. Now, as it relates to government spending and taxation and who controls it, that would be Congress and the president, right? So, what is monetary policy? Government spending and taxation. Who controls it? Congress and the president. Now, one of the dead economists that you'll be tested on, well, not so much his name, but his school of economics, Lord John Maynard Keynes. Prior to Lord John Maynard Keynes, people said the business cycle would fix itself, the invisible hand. And in the long run, that, things would fix themselves. And Mr. Keynes is famous for a lot of things, but one thing he said, in the long run, we're all going to be dead. So what we should do is fix it now. And one of the things that Mr. Keynes said is that when the economy is weak, it's because there is no demand. People who have resources hoard them and won't spend them. Other people don't have any resources. And so what Mr. Keynes said is the government, through fiscal policy, could intervene. And by intervening, that would be government spending and taxation, right, to use to smoothen out or create that demand. One of my favorite living economists, a guy's named Lawrence Summers, and he thought, well, maybe he suggested that there was too much fiscal stimulus, fiscal policy, fiscal stimulus, government spending during the COVID last round of the COVID pandemic. The government sent out checks to everybody, causing too much money, chase too good goods, and that triggered the inflationary spiral we had recently experienced. But anyways, for test purposes, demand side economics is that the government can use fiscal policy to lessen the impact of the business cycle, demand side. See, government spending and taxation is a positive influence on the business cycle. The opposite of that would be what we call supply side economics. That the government isn't the best decision maker about allocation of resources in terms of that spending and those, taxation policies. And that what the government should do is let individuals make those decisions. And, those individuals will be better decision makers. And that would be what we call supply side economics, right? Demand side, the antithesis is supply side. I'm oversimplifying, which, the SIE is all about that. But anyways, what I want you to take away from it is demand side economics. We step on the accelerator called government spending. We get the economy rolling again. We step on the brake called taxation. And again, it's a positive thing, government spending and taxation in terms of that school of economics, where supply side sees that as not a good thing. Supply side sees government spending and taxation as a detriment to the business environment. In other words, supply side would say lower taxes, and therefore those businesses, individuals have that money and they could be better decision makers. They could stimulate the economy. All right, so monetary policy test question is the money supply. Too much money chasing too few goods, that's bad. That's inflation. Recently, I had somebody take exception to my explanation of inflation, too much money chasing too few goods. And so, Dean, my textbook says it's a decreasing value of a monetary unit, which is just a fancy way of saying the same things, that your money doesn't buy what it used to, right? Anyways, monetary policy is controlled by the Federal Reserve Board. As we said, too much money, too little money. That's bad too. Too little money, right? Too little money and too many goods. That's called deflation. So both of those are bad. So one of the mandates is the Fed. Its mission is price stability. It has two missions, two mandates: price stability and full employment. And Jerome Powell, I'm making this video in the end of 2023, and the chairman of the Federal Reserve Board right now, Jerome Powell, has said we've been, for the last several months, been following our mandate for price stability, price equilibrium, and if that causes us, unfortunately, to have to worry not so much about full employment, well, so be it. That's part of having that dual mandate. Now, one of the things you get tested on is the tools of the Fed in accomplishing its mission. And one of the things the Fed does is tell banks how much they have to leave in the till to meet their everyday demand for deposits. And if the reserve requirement is 10%, that means banks have to have 10% to meet their everyday demand for banking. I joke, but when I go to the ATM and I hit $800 and it says, doesn't give me any money, says busy with your money, I kind of know that my bank is busy with my money. But I do expect that, they have enough to give me my $800, right? So it's coming up on Christmas time. The best movie ever made about banking is It's a Wonderful Life with Jimmy Stewart. I highly recommend it. What happens in the movie is that Jimmy Stewart, the manager of the bank, Savings and Loan, loses his reserve requirement. And so then he can't meet the everyday demand for banking, right? So people are coming in withdrawing money, and, he has to explain banking to them that, we don't have all that money here. It's out making loans, it's doing other things, and please be patient. And, it has to stop the run of the bank. Anyways, if the Fed wants, they can tinker with that reserve requirement. And this is one of the tools of the Fed, right? They can say, if the reserve requirement's 10%, and I make a $10,000 deposit, my bank has to keep 1,000, the other 9,000 is a loan. That bank gets that deposit, has to keep 900, can loan out another 8,100. Not Tesla, it's called the multiplier effect of money. Now, you have to meet that reserve requirement every night. And one of the rates you're held accountable for is what's called Fed funds. Fed funds is banks with excess reserves lending to banks with deficient reserves. And, you have to meet this every night. This test question, you need to know where the money is going from and where it's going to, and then it's the most volatile. So Fed funds is banks with excess reserves, lending banks with deficient reserves. It's the most vulnerable, the interest rates you're held accountable for on the test. Now, if you can't get that from a fellow bank, you can get directly from the Fed, and that's called the discount rate. Now, the problem with getting that discount rate, that's the only rate the Fed controls directly. The Fed funds, they influence it by messing with the reserve requirement, right? Excuse me. When you think about it, if I raise the reserve requirement, banks have less money to lend, and therefore you might have to pay more for it. And so when the Fed raises that reserve requirement, it causes interest rates to rise. When the Fed lowers that reserve requirement, banks have more money to lend, the money supply goes up, and therefore you shouldn't have to pay as much for it. There's more money available, lower interest rates. Right? It's all about the interest rates. So discount rates set directly by the Fed. And, the Fed's going to want some collateral if you come to them to borrow money as a bank. And what you typically would pledge would be Treasury securities. All right, well, the other two rates don't really have to do with monetary policy, but they're still testable. And those other two rates are the prime rate. That's what banks charge as best customers. I joke, that's what you pay to borrow money if you don't need to borrow any. This is what Exxon pays JP Morgan to borrow money at. Banks to its best commercial customers. And then broker call is the rate used to finance margin debt balances. I don't want to get too in the weeds on the SIE exam, but when you open a margin account, you pledge your securities as the collateral for the loan. The fancy word for pledging collateral is hypothecation. Who cares on the SIE? If you're going on to the Series 7, then maybe it's more worrisome. But then I rehypothecate, I repledge your securities to Mr. Banker. I say, Mr. Banker, here is my customer securities. I'd like a loan for my customer. Everything in that situation is copacetic. I'm using customer securities to support customer indebtedness. Not a problem. And that's called broker call. And that could be a very competitive loan. A lot of broker dealers love lending money because I'm not lending my money. Broker calls what banks charge the brokerage firm. I charge you a little extra, little vig on top of that. So it's a very profitable business for broker dealers. On the income statement, financing debit balances could be more profitable than trading securities. All right. Well, the most common tool of the Fed is open market operations. The Fed buys and sells government securities, and I like to watch the Fed, and the Fed has expanded the balance sheet of the Fed before the pandemic. It was balance sheet of the Fed was $600-700 billion. At the end of the pandemic, it was $5-6 trillion. So over the course of the last several years, well, even more than that, the Fed has been following a very easy monetary policy. When the Fed buys government securities, the money goes out. There's more money available. Money supply rises, and interest rates go down. It's all about the interest rates. And that was called easy money. Now they've reversed course, and over the last 8, 9, 10 months, they've been tightening. And what that means is the Fed is selling government securities through open market operations, the most commonly used tool of the Fed. As they sell government securities, the securities go out, the money comes in, and that tightens the money supply, and that causes interest rates to rise. I was reading where the Fed is not so much is selling as much as they could, but what they're also doing is not reinvesting the proceeds as the bonds mature. So they're doing a roll-off, they say, decreasing the balance sheet by $100 billion a month by letting those bonds mature. Wow, and then not reinvesting the proceeds. Crazy. Okay, so those are our tools of the Fed. Now, we're talking about economics. Again, don't worry too much about it. If you tell me you missed your mark on the SIE exam because of economic factors, I'm going to say, I don't know. But gross domestic product, and the test itself is very similar, is definitional. So gross domestic product is the total goods and services an economy produces. The U.S. is number one in the world. There's no economy that produces more goods and services than that of the U.S. economy. China's number 2, Japan's number 3, Germany's number 4. Who cares? The point is the total goods and services an economy produces. And we use that to determine where we're at in the business cycle. Where are we at in the business cycle? Are we an expanding economy, a declining economy? Where are we at in terms of that? Now, one thing that could tell us where we're at in the business cycle is by looking at leading economic indicators. Now, there's a laundry list of these in most test prep vendor books. I wouldn't worry about any of them. The only ones I would worry about are stock prices, the stock market, as reflected in the S&P 500. The stock market is all about earnings or future expectations of earnings. And so when they say the stock market reacted favorably today, that says collective wisdom of the crowd, right, in terms of the expectations from the market. So I would know the stock prices are considered a leading economic indicator where we're heading. Right now, the stock market is indicating, as I come to you making this video, that we are going to avoid a recession. The other one I would be worried about as a test taker is what's called the yield curve. A normal yield curve is when short-term rates are lower than long-term rates. Short-term rates are lower than long-term rates. As the Fed starts jacking up short-term rates to slow down, as they've been doing to dent demand, is the way Chairman Powell said it, dent demand. At some point, those become even, and then we can get what's called an inverted yield curve when short-term rates are higher than long-term rates, and typically that's an indicator of a recession. So we did have an inverted yield curve, and there's a lot of people speculating right now on what's going to happen. The Fed has been accused of yield curve management, keeping it from inverting by intervention, but it's kind of one of those self-fulfilling kind of prophecies. Again, you just know the definition. Short-term rates are higher than long-term rates. Now, the reason that's important is because we do get tested on the distinction between a recession and a depression in the business cycle. A recession is 2 calendar quarters of declining GDP. 2 calendar quarters of declining GDP. Germany just entered into a recession. They had 2 calendar quarters of declining GDP, gross domestic product. I would know that a depression is 6 calendar quarters of declining GDP. So a lot of times when we went into the pandemic, people say it's going to be as bad as the Depression, and a lot of economists would respond by saying, "I don't think so. Let's hope not. I think worst case is a recession, 2 calendar quarters." It's about 50-50 now in economists saying whether we're going to enter into a recession as a result of the Fed's efforts to fight inflation. But now you'll know when they say, we're worried about a recession, 2 calendar quarters. I haven't heard anybody say they think it would be 6 calendar quarters. I like Will Rogers' definition. Will Rogers said a recession is when you're out of work, a recession is when your neighbor's out of work. A depression is when you're out of work, right? So that business cycle is important because, that helps us in terms of distinctions of what kind of companies we want to invest in. Some of us do top-down analysis, fundamental analysis, where we look at the economy, we look at the industry, and then we look at a particular company. And so in the financial statements, the balance sheet and the income statement, we can kind of make decisions about how prepared this business may be for that business cycle. Perhaps it's a cyclical industry. When things are good, things are really, really good. But when they're bad, they're really, really bad. And if that is a cyclical kind of a company that we're looking at in the financial statements, we would expect them to perhaps have more cash than other businesses in different industries would have. Because you got to have enough cash to make it through the business cycle if there's a trough, right? This would be like an automobile company, for example. When things are good, they're really, really good. When they're bad, they're really, really bad. We also get tested not only in cyclical stocks, in which case we want to make sure they have a strong balance sheet, but also defensive stocks. Defensive stocks sell products and services resilient to the business cycle, right? So economy, if I think the economy is going to go through a recession or depression, I would like to allocate my assets in such a fashion, if I'm still going to be in equities, that I have some defensive stocks. Defensive industries would be like utilities. Nobody wants to go back to the Stone Age. I might cut back on my usage, but I'm not cutting back, going back to the Stone Age. So utilities, pharmaceuticals, you're sick. I'm a doctor. I tell you need a certain drug, you're going to buy it. So those will be what we call defensive stocks. Groceries, food, you got to eat regardless of the business cycle, things like that. We also get tested on growth stocks, and typically growth stocks are able to grow independent of the business cycle. But, the way we identify these as SIE test takers, they typically pay little or no dividends, right? We would expect them to take any resources they have and build the business. And if I'm an investor who owns a growth stock, I'm into price appreciation. The only two ways I'm going to make money is through the income stream on an investment, and stocks, that would be the dividend, and or price appreciation. So if it's a stock with no dividend, well, then that means we're going to need price appreciation. All right, so international economic factors. Nobody expects you to be, a PhD in international economics. But we have been talking about the Fed, and we've said that currently the Fed has been tightening monetary policy. We said through the tools of the Fed through open market operations has been shrinking the Fed's balance sheet, meaning, again, selling the government securities, causing the money supply to contract and interest rates to rise. And, when the U.S. interest rates are rising, it makes the dollar more attractive. And so usually, as the Fed right now has been raising interest rates, the dollar has become stronger relative to other currencies. Now, what you do get tested on is how does that affect a strengthening or weakening dollar with the U.S. balance of payments, right? So, countries are like individuals and they have a balance sheet. Debits is money out, credit is money in. So, if it used to take 10 pesos to get a dollar, and now it takes 20 pesos to get a dollar, the dollar has strengthened against the peso. It doesn't make any sense to tell me the dollar is strengthening or weakening unless I tell you what the other currency is, right? So, currencies have this inverse relationship. And so, it used to take our Mexico friends to buy a Caterpillar, D11 bulldozer. They're building a lot of stuff in Mexico, building a train, they're building a new airport. To pay for that Caterpillar D11, they're going to have to come up with twice as many pesos as they used to. And so a strengthening dollar is going to, in terms of the balance of trade, is going to weaken it, right? Because it's going to make U.S. exports less competitive, and U.S. imports more competitive from the U.S. perspective, by the way. So if you have any international perspective, you are risk, right? So, that's going to be twice as much to buy that Caterpillar. Now, in terms of Dean, who likes to drink tequila, it's wonderful. It used to take 10 pesos to get a dollar. Now it takes 20 pesos. So my dollar gets me 20 pesos. So what that means is my tequila that used to cost me $80 a bottle, that's a high-end tequila, is now $40 a bottle. Woohoo! So a strengthening dollar has the balance of payment effect of making exports less competitive, U.S. exports, and U.S. imports, tequila, more competitive. So that's that version. Now, if the dollar is weak, it would have the opposite effect. Right now, it takes less pesos to get a dollar. So here, U.S. exporters now can sell their Caterpillar, I'm using Caterpillar D11, for less money. Our Mexican friends have less of a problem coming up with the pesos necessary to pay for the Caterpillar D8. And then again, it would cause U.S. imports to become less competitive because now Dean needs to come up with more dollars to buy that bottle of tequila, right? It went from 20 to 10. Now it's 10 to 10 to a dollar. That would have that opposite effect. The one that shows up most often on the test is the effect on the dollar being weak. And, the test is kind of like in favor, I guess, is the way I would say it, prejudicial about U.S. exporters. So what they like to ask you is, what is the effect on the balance of payments, the balance of trade, when the dollar is weak? And you would say U.S. exports become more competitive, U.S. imports become less competitive. All right, well, the last thing we want to talk about in today's podcast, one other point. I linked to 2 economics lectures I have, but somebody was watching one of the episodes and said, oh, well, there's more than that. Oh, absolutely. It's a podcast. It's not, the lecture. So, I will link to the lecture, but podcasts are a flyby, something you can listen to at the gym, I hope, or in your car or something like that. They're not, a PowerPoint presentation on economics. I have, I think, 2 or 3 of those, and I'll link, but just want to, again, remind you that podcasts are different than lectures in that regard. All right. So the last thing we want to talk about in today's episode is 1.4 offerings, that we make. Offerings are made either publicly or privately, depending on how we're doing the deal, right? And we're going to have various participants we get tested on the SIE. If you're an issuer, it behooves you to hire an investment banker because the most egregious sin you can commit is to make a fraudulent distribution of securities to the public. And so you need to hire an investment banker who knows how to do this correctly, how to comply with the Securities Act of 1933, the template, the Uniform Securities Act, all that stuff. Now, when we're not underwriting securities to lessen the risk, we might form an underwriting syndicate. So syndicates are formed where various investment bankers form a syndicate to go out and bid on bonds or sell the stock, whatever the case may be. And then there's going to be a syndicate manager, and the syndicate manager is going to be first among equals. And that syndicate manager is going to be the one who handles the, the orders coming in. The process in a stock, for example, if we're doing an S1 registration, that just means a traditional initial public offering, is we're going to make that registration statement telling the SEC that we intend to sell brand new securities to the public. Then we're going to enter into the cooling off period or quiet time, which is a minimum of 20 days. And, we got to have somebody who's going to accept or track those indications of interest, which are non-binding in all parties. Typically, that would be the syndicate manager that does that. So we'll have syndicate members, we'll have members of the selling group. Now, on the municipal side, we're called municipal advisors. So broker-dealers typically have corporate finance, men and women who raise money for municipal corporations, corporate finance, private, money for private corporations. We have public finance, men and women who raise money for municipalities. And again, it would behoove a municipal issuer. Oh my goodness. There are 50,000 municipal issuers of securities. Wow. With over $4 trillion in debt outstanding. Now, 50 of those 50,000 are states. So 49,500 cities, counties, school districts, transit districts. And they would hire a municipal financial advisor, public finance, that's men and women at the broker-dealer raise money for municipalities, to tell them how to best proceed, whether they should do a negotiated underwriting or competitive underwriting, should they put a notice of sale, all those kind of things associated with underwriting municipal securities. Now, I would know that municipal securities are exempt from 33, meaning there is going to be no prospectus requirement. There's not going to be any kind of a cooling off period. It's going to be a different deal. And as we said, it's either going to be a public offering or a private offering. If we're doing an initial public offering, at the same time as your investment banker, I say, listen, at the same time I'm doing that IPO, I would like to do a shelf registration. I would like to tell the SEC that within 3 years, we're going to come back and raise some more money. Our shelf registration, if we're a well-known seasoned issuer of securities, a WIXI, our shelf registration would be good for 3 years. It's better to have the securities on the shelf and not need them than need them and not have them. And so, we do our IPO at maybe $100 a share. And then 2 years, the stock's 200. We come back, we raise some additional money, taking down our shelf. Take down our shelf. So shelf registrations is shares that are authorized, registered, but till we exercise the shelf are not issued. So registered, unissued shares on the shelf at the SEC. The shelf registration, better to have it on the shelf and not need it than need and not have it. It doesn't have to be used just for the follow-on offering. It could be used to take down our shelf to make an acquisition. For example, Disney bought Fox and used its shelf to pay for it. What I mean by used its shelf, it took down its shelf registration and said to the Fox shareholders, for every share of Fox, here's X shares of Disney. In terms of corporate events, that's not a taxable consequence because you didn't receive any cash, right? So shelf registration is securities that are authorized and registered, unissued until we sell them through the exercise or through the use of our shelf registration. What would I know about that? I would know that for a well-known seasoned issuer of securities, that shelf registration is good for 3 years. 2 methods of distribution. Best efforts is where I tell the issuer I'm going to do my damnedest to sell the securities, but I'm not willing to buy them, the syndicate, personally. There's this thing where we are tested on whether we're acting in our agency capacity or our dealer principal capacity. My firm was called Gamma Global Investments. All I did was best efforts underwritings. And we're trying to get this deal done. And the guy said, Dean, do you think I should invest? And I said, well, I'm going to answer that question for you. But before I do, you need to know something. I'm an agent of a broker-dealer, and my broker-dealer is an agent to the issuer. This is a best efforts underwriting. And we can't break the escrow account until we get the proceeds we need into that escrow account. And if you go through with the investment you're contemplating, that would allow us to break escrow. And so the answer is, I do think you should invest, but you need to understand something. I'm not acting as your agent. I'm acting, the broker-dealer, as an agent to the issuer. And he says, oh, cool. The point is, he wants somebody to represent him. He needs to go get somebody else, right? Excuse me. It's not testable, but, this idea of conflicts of interest certainly is. Now, in a firm commitment underwriting, that's where the underwriting syndicate tells the issuer, we're so confident we can sell the securities that as far as you're concerned, they're sold. The initial public offering of Facebook was a 38 was the public offering price. And it was a firm commitment underwriting led by Morgan Stanley. And, people asked Zuckerberg, aren't you a little worried? Because it was kind of wobbly. People forget it was wobbly at 38. IPO either stands for instant profit opportunity or it's probably overpriced. And this scenario, IPO stands for it's probably overpriced. And it's a sticky issue, not testable. Now, this conversation is testable. I'll tell you what part is when we get there. But anyways, they were asking Zuckerberg, and he said, well, what do I care? As far as I'm concerned, that stock is sold at 38. Morgan Stanley Syndicate gave me a firm commitment underwriting price at 38. Sounds like their problem, not mine. That's a pretty good understanding of a firm commitment underwriting. Now, the point is, in a firm commitment underwriting, in this example, you're not buying the stock from Facebook. You're buying the stock from the syndicate. So in a firm commitment underwriting, we're acting in our dealer principal capacity is the point. Best efforts, the investment banking firm is acting as an agent to the issuer. In a firm commitment underwriting, the broker-dealer is acting in its dealer principal capacity. Documents. So the official statement is the prospectus-like document when selling brand new municipal bonds. I would know that. Which document goes to what. Private placement memorandum is used in Reg D private offerings. We talked about that, right? I say, listen, before I send you a copy of the private placement memorandum, the PPM, I need to verify you're an accredited investor. Do you have $1 million net worth? Do you make $200,000 over the last 2 years or $300,000 this year? We talked about that in earlier episodes. If it's a public deal, we're using a prospectus. I was raising money in a private placement, Reg D, and, the issuer used to drive me nuts. And, they'd say, oh, here's a copy of the prospectus. I go, I know you guys think I'm being, a problem person, by correcting you all the time. But please don't call that a prospectus. It's not a prospectus. It's a private placement memorandum. A prospectus would mean this is a public deal, and it's not. So that's important. I know you don't think it's important, but it is. Please refer to the proper document properly, right? Prospectus means public deal. Private placement memorandum means it's a Reg D deal, right? These are the things we use. And then we have to register the securities. Now, we're not going to register, remember, the private placement with the SEC or the state. The private placement is one of those safe harbors under 33 where we can sell it without making a registration statement. But in general, we need to register security with the SEC in any state in which we plan on selling it. And that's called coordination. Looks like I have a typo here in my banner. But right, so you have to make sure you register the security with the SEC if you're selling it to the public, unless the security is exempt or the transaction is exempt. Now, I wouldn't get too much in the weeds on your SIE, but unless the issuer is exempt, if the issuer is exempt, the securities are exempt because the only kind of security an issuer can give birth to would be an exempt security. So what I mean by that is the big ones on the test are U.S. government securities and municipal securities are exempt from registration with the SEC and the state. And then the other one I would be aware of is a private placement memorandum. Those are safe harbors. Now, under 33, we have Reg A, another safe harbor available to us where we don't register the securities, and we have Rule 147. Those are what we call safe harbors under 33, meaning no need for registration. But in general, the point is, if you're going to sell brand new securities to the public, you're going to have to make a registration statement with the SEC in any state in which you plan on selling it through coordination. And then again, when you come back to take a 63, 65, or 66, will torment you on various exempt transactions and exempt issues as it relates to the state registration requirements. Wouldn't worry about that on your SIE. We refer to these as blue sky kind of laws. Anyways, all right. So I think that concludes our episode for today. We have one episode left in our podcast series. It's episode 11. If you're joining us real time, that'll be next week, or if it's already in the can and broadcast available on the channel at this point. If you need any clarifications on any of these, feel free in the comments just to ask me, like whether it's that registration thing. I kind of rambled there a little bit, but if you need some clarification on anything found in any of these episodes, just put that in the comment box. I respond rather quickly to that. Remember, inch by inch, your SIE is a cinch. Yard by yard, your SIE is hard. And I'll see you for our next installment.